Hello, everybody. Bill Prince again, and we're going to spend a few minutes covering some of the material that's in Chapter 13, which deals with shareholder rights and corporate governance. In Chapter 13, we will look at issues related to stockholders as stakeholders. As always, let's review the learning objectives for the chapter and the week. We're going to identify different kinds of shareholders and understand their objectives and legal rights. We're going to know how corporations are governed and explain the role of the board of directors in protecting the interests of investors and other stakeholders of the corporation. We're going to be analyzing the function of executive compensation and debating and discussing if top managers are paid too much. We're going to be evaluating various ways stockholders can promote their economic and social objectives, and we're going to understand or attempt to understand how the government protects against stock market abuses such as fraudulent accounting and insider trading. Stockholders are the owners of the business. Generally, there are individual investors who invest for a multiple set of reasons and institutional investors. One wonders if the increase in institutional investors has created a vacuum wherein officers and directors have more power and autonomy in their say over the corporation. Stock investment in publicly traded corporations continues to increase over time. People own stock for a variety of different reasons. The two biggest reasons are economic reasons, to make money, and social reasons, or to achieve some sort of social goals. Get a ticket to the shareholders meeting to complain, gripe, whatever. Slide 6 sets forth a number of rights that shareholders have. Keep in mind that corporate law is primarily state-dominated in the sense that state statutes control corporation law, and so some of these rights will vary from state to state. But generally, most shareholders have the right to share in profits of the enterprise if directors declare dividends. They have a right to receive annual reports of company earnings and company activities. They have rights to inspect the corporate books. They have rights to elect members of the board of directors of the company. They have the right to hold the directors and officers of the corporation responsible for their actions. They have the right to vote on mergers, some acquisitions, and changes in the charter and bylaws of the company. They have the right to bring other business-related proposals before other stockholders, and of course, in most cases, unless they're subject to some sort of buy-sell agreement, which traditionally we see in closely held situations, they have a right to sell their stock or otherwise dispose of it. Slide 7 is simply a visual depiction of those rights that we talked about on chapter or in slide number 6. Corporations are owned by stockholders, but governed by officers and directors. Generally, those individuals owe what's called a fiduciary duty to those owners in that they have to exercise reasonable and prudent business judgment. Boards of directors set the overall direction for a corporation and are of various sizes. Some boards of directors consist of inside and outside directors combined. We have seen a trend lately to the professionalization of directorships after many of the scandals of the past. In the past, many times directors were somebody's best friend or golfing buddy or things of that nature, but when we saw many corporations take financial tumbles due to mismanagement and lack of oversight, we started to see more professionalization of directorships. Best practices for good corporate governance include the following principles. You should utilize outside directors. Again, avoid that groupthink. Directors should be elected rather than appointed. Directors should lead independently. They should have an independent lead that directs them. Director compensation should be linked to corporate performance, and board performance should be regularly evaluated. We have seen global responses to corporate governance issues, many of which plague the United States. Many countries have taken far more aggressive steps to curb abuses by officers and directors than has the United States. Following the financial crisis of 2008, many thought that we would see more stringent rules applied to directors and officers of U.S. corporations, but those reforms have not materialized. Following the financial crisis of 2008, there was a big discussion regarding the relationship of executive compensation to corporate performance. At a glance, it would appear that the amount of compensation paid is way out of whack in comparison to performance. However, no serious efforts have been made to limit executive compensation in the United States. The median executive compensation in 2014 was $17.6 million per year. Compare that with the wages of an average company worker. One way to deal with this issue of executive compensation and of its excessiveness has been the idea of pay for performance, where corporate performance should be tied to the compensation of the officers and directors. One wonders, however, if this will make the bottom line too important at the expense of social responsibility. Slide 16 sets forth some of the arguments, both pro and con, related to executive compensation. Those in favor of high executive compensation would suggest that well-paid managers are simply being rewarded for outstanding performance, that high salaries provide an incentive for innovation and risk-taking, and that high compensation reflects a shortage of labor necessary to attract top talent. Those who would make arguments against excessive executive compensation would include those arguments that inflated executive pay hurts the ability of U.S. firms to compete with foreign rivals, high executive pay causes mid and lower level employees to feel that they are not receiving their fair share, and empirical evidence finds a weak relationship between executive pay and company success. Again, one only needs to look at the companies that were driven into the ground by their officers following the 2008 corporate crisis and the excessive compensation that those folks received in exchange for doing that. While some light provisions were put into place regarding executive compensation during the Obama years via the Dodd-Frank Act, one of the goals of the new administration seems to be to dismantle those regulations, and it seems as if we are seeing a systematic attack on getting rid of those financial regulations that were put into place following the 2008 crisis. One thing that we've seen, however, is more and more shareholder activism in response to actions by corporate officers and directors. People will invest in stock for social reasons, to support causes they believe in, or to be irritants to certain corporate entities. Some investors have begun to insist that mutual funds and institutional investors screen stocks in which they invest to ensure that the stock owned represents ownership by good corporate citizens. We have also seen an increase over time in the number of shareholders' resolutions that are filed by shareholders. These can be a good sounding board to discuss a number of corporate and social issues involving the company. Stockholders, through what are known as derivative lawsuits, have the ability to sue their own corporation if they believe management is taking actions that damage the company. The outcome of these suits can be extremely expensive for the company. In response to more stockholder activism, we have begun to see, and not so recently, but within the last 15, 20 years, more open book management, which has become a trend to increase the level of corporate transparency in an effort to be socially responsible. It has been a good trend for stockholders to be more actively involved in the corporations they own. In the past, stockholders would simply throw away the proxy cards that they would receive every year with the annual report and default to management in making major decisions. This trend has changed, and I suspect we will continue to see it change as we progress. Well, that deals with the stockholder as stakeholder. In our next chapter, we're going to spend a little bit of time looking at the consumer as a stakeholder. So we'll visit with you then. Have a great week.